So whereas time is a little bit less, one can make up for that via deploying more capital by being scrappy. Hey everyone, this is Ian from ppcian.com. I am back with another video about dividend growth investing. I'm an investor who invests for cash flow and passive income. I like to receive dividend checks in the mail every single month so that my dividend checks can pay for living expenses, and one day will pay for all of my living expenses. So I receive a wealth of incredible questions here on my channel, and today's video is in response to one of your questions. This is actually a recent one. One of my viewers, one of my subscribers just recently asked, "Hey Ian, I feel like I'm getting started a little bit later here. I've come across your channel. I really like this concept of investing for cash flow and passive income, specifically in dividend paying stocks. However, I'm in my 30s. So, as I always do, I've got my notebook. I jotted down some notes about this very topic. And one of the first things that I want to mention is starting in your 30s and 40s, in my opinion, is not starting that late. In fact, 30s and 40s, it's just not that late. There are still many decades ahead, many decades of investing and compounding that can occur. That being said, obviously it is later than if someone started in their 20s or even their teens. But that being said, again, I don't know if I would classify 30s or 40s as a late start. And the reason I just want to start with that point is I think half of the battle in investing is psychological. It's about how one approaches the situation. It's about how someone thinks about the situation. And I would think, if I were just starting, I'm in my 30s by the way, but if I were just starting out now, I wouldn't necessarily approach it as, hey, I'm late to the game. I still think of these next 2 decades here, 30s and 40s, as being really youthful decades and many, many years ahead. And one nuance just worth noting on that point is people are living a lot longer these days, and it's foreseeable that we will all live a lot longer as each year passes because of advances in medical technology, because of advances in the healthcare industry. And so that's just something to be aware of in the scheme of things, because we're especially because we're all living longer. 30s and 40s, it's still reasonably young. And so if there's one message everyone takes home today, is definitely don't feel discouraged if you're just starting in your 30s or 40s. That's a wonderful time to start in the stock market, in investing for one's future, for passive income, and it's just a great time to start. So that being said, there are two main factors when it comes to dividend growth investing. There's time and there's money invested. Those are the two levers really that we all have to drive income from dividends. Obviously, we have to select the right positions, the right stocks as well, and buy them at the right time. But at a very high level, there are two levers, and one is how much money I put in, one is how much time I have on my hands. And so each year that passes, there's less time on my hands. And time is very powerful because the more years that one's money is in the market, the more years that it can compound and work for you. And in fact, in the early years, like I'm in right now, I'm not living off of my dividend income. I'm generating a lot of dividend income. I've been at this for more than 20 years. But the fact of the matter is I don't need it right now to live. I'm not using my dividend income to live, and so I'm reinvesting it. It's building a snowball. Those dividends are compounding. And so the more time one has in the market before they experience early financial freedom or they experience retirement, the more time that one's portfolio can grow, and it can grow at an accelerated rate because dividends can be reinvested. That said, the other big lever is money, how much money one can invest. So if one is starting a little bit later, like their 30s, 40s, or even 50s, time is not on one's hands as much as it was in their teens or 20s. There's still, though, a lot of time, as I had already mentioned, but there are ways to make up for that. And the number one way to compensate for less time is by investing more money. And so if I were just starting out all over again right now, one thing that would be very important that would be going through my mind is, Ian, what can I do to get the maximum amount of money in the stock market? So I would start thinking about things like, hey, should I be just cutting my budget? Are there things in my budget that I can completely cut? Maybe even things that I don't want to cut, but I can live without them. I would be making drastic cuts to save money that could go into the market, and simultaneously lowering my cost of living so that it's easier to reach financial freedom, because the lower one's cost of living, the less passive income they need coming in to pay for everything. So there's a double effect here. There's two benefits from doing this. One is getting more money in the market, but one is reducing cost of living. So what I would especially focus on is how much money I am saving as a percentage of my income. If I bring in, say, $50,000 a year, if I save $10,000 of that, that's 20%. If I can save, let's say, another $5,000 of that, $15,000 total, it brings me up to 30%. Save a little bit more, the ratio keeps going up. The key here is to look at the income that's coming in and try to have a really powerful ratio. I would say if I were just starting out all over again, I had no money in the stock market, I personally would be targeting somewhere between 25 and 40%. I know that's a broad range, but the reason I leave it broad is the cost of living varies quite a bit throughout the United States and throughout the world, and where I live in the Greater Bay Area, it may be harder for most people to do more than 25%. But if I lived somewhere where the cost of living was more affordable, maybe 40% would be a no-brainer. It'd be easy to save 40% of my income. And so if I were just starting, that would be something I would be keenly aware of. I would be totally focused on reducing expenses and making sure that the percentage of income that's coming through the door, a big percentage of that, somewhere probably between 25 and 40%, is being saved and going directly into dividend-paying stocks. I would also make sure to get my money working for me now. I think there's this element of market timing. There's this element of, hey, is the stock market at all-time highs? It is right now. Should I be waiting? Should I just save cash and wait 5 years? For me, again, I'm speaking hypothetically. In my personal situation, if I were just starting now, I would not wait. I would just average in. I would average in each and every month, dollar cost average. It'll mitigate my risk. Sure, some of my buy orders might come in towards the top of the market, but as the market corrects at some point, I'll be buying all the way down, so it'll average in. But the fact of the matter is if I'm already starting a little bit later than I had hoped to start, I would want my money to start working now. So whatever time is left can work. It can compound. I can start receiving the dividend checks and reinvesting them in the stock market. What else would I do? There's this concept of delayed gratification, and I think it's a really important concept for dividend growth investors, because that's honestly what we're all doing. We're trying to accumulate a sizable portfolio of wealth that will sustain itself, that will pay dividends, that we can live off of, so that we don't have to tap into the principal. And to do that, we all have to make trade-offs in the short run, in earlier years. I sure know I've made some trade-offs to get money working for me. If I were just starting in my 30s and 40s, I would probably want to make even more trade-offs. So we've already talked about some of those on the budget cut standpoint, but what about taking on a second job? What about taking on more work? Maybe one already feels tired. Maybe they don't want to take on more work, but sometimes by pushing themselves just a little bit, you don't want to go overboard necessarily, but pushing oneself just a little bit to get extra money made that can go into the stock market, that's another way of getting money working for one now. And your future self very well may thank your present self, as long as your present self doesn't burn out or take on too much. But I think this is interesting because a lot of dividend growth investors, bloggers out there, they're always talking about cutting expenses. And I think that's key. It's often easiest to cut expenses, but there's a certain point at which it's not very easy to cut expenses, and it may be easier just to take on more work to drive more revenue. And that revenue that's made on the margin, all of it can be saved because it doesn't need to go towards living expenses. What else? I would avoid mistakes. I have made my fair share of mistakes over the years, and a lot of these were in my teenage years when I was just getting started out. I learned the hard way. When one is just starting out in the stock market in their 30s and 40s, mistakes cannot be made. And so I think there's a level of seriousness that one must approach investing with that is very different from a teenage investor or even someone in their 20s that wants to test some different strategies. If I were just starting in right now, this wouldn't be a time for me to test new strategies. This would be a time for me to pick one strategy, one that is relatively conservative, such as dividend growth investing, and go all in on that strategy. What else? I would set up realistic goals. I think if one is starting later, it is going to be a little bit more difficult, not impossible, to hit an early financial freedom, maybe retiring before 60 years old, having a massive amount of cash flow that pays for everything. That being said, it's very possible, so I wouldn't give up on dreams either. There are different ways to make dreams a reality. Perhaps moving to an area where it costs less to live when one is ready to experience an early retirement, for example, could make those dreams a reality. So I just think someone in their 30s, 40s, just getting started out, may have to be a little bit more creative and set realistic expectations when it comes to achieving those dreams of early financial freedom. I like this one. When one is in their 30s and 40s, they're in later stages of life. It may be that one has found their partner and they've gotten married. It may be that someone has kids. And when one is in these stages of life, what's great oftentimes is if one has a partner, this is a team sport. It's no longer an individual sport. So when I was just getting started in my teens and 20s, it was just me. But now I'm married, I have a wife, and we oftentimes approach investing together as a team. We talk about our financial goals as a team. And I think what is important, if one happens across this concept of financial freedom later in life, one wants to go after it. Perhaps it makes sense to approach it as a team sport. Talk to your significant other, come up with a plan, and in fact, if you're a single income family right now, maybe it makes sense in the short run to make some sacrifices and become a double income family. Maybe by taking on that double income, it will give the capital to invest in the stock market now, and maybe it's a sacrifice that's made for the next 5 or 10 years that pays off handsomely in the long run. And so it gets very interesting. It's almost maybe one feels behind if they're starting in their 30s and 40s, but at the same time there's some unique advantages that a 30 or 40-year-old has that a younger investor might not. And I think it oftentimes comes down to that potential for a double income. What else? I think I've already talked about this a little bit, but I think if I were just starting out again, and this is obviously even how I approach it right now, even though I've been in the game a long time, whether the market is up or down, I wouldn't try to time things if I were just getting started now. I would just be in, I would dollar cost average in, and I'd keep that laser focus. I'd stay in the game. I wouldn't deviate from my strategy. I would just keep focused because there's no time to waste. The time is now. I would definitely reinvest all dividends. I think in dividend growth investing sometimes, especially as the dividends start rolling in, it gets tempted to spend them, to buy things with them. That makes sense when one experiences financial freedom, or maybe a more balanced life where they can work part-time and then supplement their income with dividends. But when one is trying to build a snowball effect quickly, it's essential to reinvest the dividends. And so definitely if I were starting a little bit later, I would keep laser focused on reinvesting my dividends. So just to conclude today, if one is starting later, definitely 30s and 40s, that's not very old, so I definitely wouldn't feel like it's too late. I think I know there are two levers that are very important in the world of dividend investing. One is time and one is capital invested. And so whereas time is a little bit less, one can make up for that via deploying more capital by being scrappy. And thankfully, the life expectancy for all of us continues to increase. And so hopefully everyone watching, myself, will all be around for a very long time. And 30s and 40s will just be one of those first innings of the game. And we have many good years ahead. And so it's still a very early time to start investing in stocks for dividends. Thank you so much for watching today. If you enjoyed the video, I please invite you to subscribe, to like the video, to comment. The questions that have been coming in, they fuel videos just like this, so it is the greatest compliment you can give me for creating this content here on YouTube by providing suggestions for my channel. I greatly appreciate it. I value it. I truly thank everyone for their support. Before I leave today, just a friendly disclaimer. This is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you are going to go out and invest money in the stock market or anywhere else, please do consult a licensed financial advisor first. My name is Ian Lopuck. I'm from ppcian.com. Thank you so much for watching, and I will see you in the next dividend investing video.